Hi, I hope the market's treating you well and you're enjoying our weekend videos wherein we talk about the market and try and make sense and sensibility out of the market moves. The last 17 videos I would say have basically justified the levels that I have been advocating for the markets, and I hope you're satisfied with the kind of inputs you're getting from me. This channel is to help you. I'm here to help you become better traders, and in that tradition, I'm going to record this video as well. Now friends, this week is unlike any other week that is likely to be seen in the market, for the simple reason that you have a very big trigger in the market, which is called the union budget. Now this event is mostly preceded and followed with periods of high volatility in the market. So at the end of this video, I'm going to include one more section which is dedicated to your broad game plan as to what you should be doing in the market specific with the budget week. So the markets continued with their decline for the second week in a row, and last week I had expressed my concerns about margin calls, which is the requirement of additional margins, mark-to-market margins by brokers from clients who were holding long positions and were losing money. And I expressed concerns that these margin calls will trigger further downsides in the market. And sure enough, it really happened, and the downsides actually accelerated. Do remember that now it's been 3 weeks since I've been consecutively warning you that the markets are looking kind of toppish, they are looking top heavy, and there is a possibility of declines. And the budget, like I said, is likely to add to that volatility. Now coming up on your screen is the roundup window, and what you can see is on the graphic that the Nifty 50 actually fell more than the Bank Nifty, and fell over 5% on a week-on-week basis. Bullion, both gold and silver, rallied because of defensive safe haven buying, and oil fell, which was a very slight positive, but natural gas rose, which is a negative, because natural gas is used extensively in India for cooking as well as transportation and as a clean, relatively clean energy source. Now, the US dollar rose against the rupee, and I have been telling you why emerging markets, including India, need a weak dollar, because we are import-dependent nations, and a weak dollar means lower landed cost of imported goods and therefore lower imported inflation. Now, when the dollar rises, our markets do tend to get a cold, which is what happened. Now, the 10-year benchmark bond yields were steady, and I've also told you why you should never ignore the bond market, because this is what impacts the equity markets, particularly banking and Bank Nifty, the most. So even if you're just an equities trader, do keep your eyes out on the 10-year benchmark bond yield, which this week happens to have been flat on a week-on-week basis, as it shows on the graphic. Coming up on your screen is the MWPL, or the market-wide position limits. I hope you enjoyed the recent video about MWPL, wherein I explained to you the very concept of what it is and how you can use it to become better traders. So the MWPL fell by 8.11 points due to the expiry, and I've marked with a red arrow where the expiry of the January futures was seen. And from here on, I expect a steady increase in the MWPL, which is what the usual precedence is after expiry. On your screen now is the basis chart. Now the basis means the premium that the future enjoys over the spot. Now you can see that the basis is seeing an uptick or an increase, because this is the beginning of a new derivative cycle, the February series. And you have 4 clear weeks to expiry of the February series, which is why the futures are commanding a reasonable premium over the spot. The volumes chart on your screen shows a decline in both the index and stock futures turnover. Now this is across all expiries, which is February, March and April. This is the cumulative expiries, and both the indices and stock futures have shown a decline because the markets have fallen last week and traders are busy nursing their existing positions rather than take fresh exposure in the derivatives space. The budget on Monday may just wind up escalating the turnover and raising the beta or the volatility levels even further. Now friends, we come to the 10-year benchmark bond yields, and this is, like I've said many times in the past, a very critical indicator because the bond markets are the fountain of all monetary supply. As a matter of fact, the bond market is anything between 50 to 80 times bigger than the equities market worldwide, which is something that novices and non-market participating experts tend to ignore. Don't let anybody tell you that bond markets should not be watched, especially if you're trading the bank Nifty or banking stocks. You just cannot ignore bond prices. So basically what you saw is that the 10-year benchmark bond yield was steady, which is why the bank Nifty fell less than the Nifty 50 and therefore became a relative outperformer. But last week I showed you a screenshot of my social media account wherein you saw that the RBI has already issued guidance about tightening the monetary supply, and which basically means tightening the money flow to the market. And easy money flow, ample liquidity at low cost is mother's milk to a bull market, and whenever you shut off the money supply, the markets do tend to go into jitters. So keep a very keen eye on the bond market and don't let it escape your attention, especially after the budget. Friends, we now come to the US dollar index, another very critical area which is neglected by many traders, but it has a direct impact on our equity markets. Remember, we have a lot of foreign denominated debt in which we are servicing the debt or paying interest in US dollars. Therefore, a strong dollar means higher outgo. We are also net importers, and whatever we import is largely paid in dollars. So we want a weak dollar so that we can control our inflation. Now, the US dollar index is a US dollar currency benchmarked against the global basket of currencies. And this dollar index, or the Dixie as it is called, rose 0.5% on a week-on-week basis. And we basically saw the index rising on 3 out of 5 trading sessions. The index also stayed above its 25-day exponential moving average for most part of the week, as you can see on your screen. And it's also critically poised at the verge of a breakout above a bearish wedge upper trend line. A rally in this index will be negative for our equity markets. And if you look at the weekly chart coming up on your screen, you will see a bullish piercing pattern wherein the last bullish candle has partially pierced its previous bearish candle from below. Follow-up buying support, if it is forthcoming, will take the index past the bearish wedge and therefore pressurize emerging market equity markets like including India. So you do have to keep your ears to the ground and watch this aspect of the market as well. Last week, I advocated an estimated range between 91.30 on the upside and 89 on the downside, which held beautifully well. In the coming week, I expect an estimated, I'm emphasizing on the word estimated here, a range between 91.70 on the upside and 89.50 on the downside. The Dixie done, my friends. Let's move on to the bank Nifty and see what's in store for us. Now the Bank Nifty fell on 2 out of 5 trading sessions, but the falls were sharper than the rallies, which is why this index fell on a net basis on a week-on-week basis, and bond yields have partially saved the day because bond yields were steady, and had the bond yields basically moved against the Bank Nifty, which is if the bond prices had fallen and the yields had risen, you would have seen mark-to-market losses on the banking stocks balance sheets. So this was a saving grace, which is why the Bank Nifty fell less than the Nifty 50. Look at the chart, how this index is now below its 25-day exponential moving average on the daily chart. The tiny inverted hammer I had pointed out in my previous weekly videos, marked by an arrow, proved to be a turning point. The daily and weekly ranges have expanded mildly because the downward momentum is accelerating and therefore the base effect is getting bigger. Now coming up on your screen is the weekly chart, which shows a long-legged doji. We talked about this last week, and I've marked it with a red arrow as well. This was an indication of indecisiveness, and I had told you that any decline below the low of this doji would trigger downsides, which is what the markets actually did. The decline is now 2 weeks old, but the Bank Nifty's weekly chart shows the price still remains above its 25-week exponential moving average, which means there is still marginally some sign of hope if at all the budget happens to have some positive triggers for the markets. The closing on this index has been at its lowest in 6 weeks. And the last 2 weeks of declines have wiped off the previous 4 weeks of gains. But I want to ask you whether this is really so. Is this just 4 weeks of gains gone? Now, there is something that non-market participants and who are commenting in the public domain tend to miss out. The real world traders who actually risk their money would tell you that if they are holding long positions month after month and rolling these long positions forward, they would be incurring rollover costs, carryover costs, brokerage, execution costs, taxes, the difference between the current month future and the next month future. So the losses to a bull are actually larger than what it shows on your screen. Now, this is a psychological aspect which will weigh on the sentiments in the markets in the coming week. And this is something that you've got to be a trader to actually understand. In the week gone by, in the week before last, this index was at number 5 of the most volatile list. But last week it moved 3 notches higher to close at number 2 on the most volatile list. The higher is the volatility, the bigger the shocks. Sudden large price moves can occur in either direction, which means the trader will have to be on his toes all the time because volatility is so high. Last week I advocated a possible range between 32,575 and 29,750, which was violated very mildly on the downside because the low we tested was 29,688. Now that's like 62 points below my expected support level. The coming week is expected to see a possible, I'm using the word possible here, range between 32,050 and 29,000. But let me warn you, being a budget week, I expect volatility to jump up significantly, which means that this range can be violated. Possibly a higher probability exists that the decline might be wider than the rally. So the range being violated is a very high possibility. Don't bet the farm on this support level of 29,000. The Bank Nifty done, my friends. We now go to the most liquid counter on the NSE, the Nifty 50. Now the Nifty is the most liquid, low impact cost and has the finest or the lowest spread between the bid and the offer bid and the offer. Now this index fell 5.13% on a week-on-week basis and is also trading below its 25-period exponential moving average. The 14,000 round figure, which I talked about last week as a potential support, stands violated, which is a sign of concern. And note how the price made a higher high, but the RSI in the lower window made a lower high. Now this phenomena is called negative divergence. I've marked the same with red color arrows here. Note how the blue color dotted trend line is likely to provide some short-term support at 13,500. Now here again is a mid-round number, 13,500. So if this 13,500 level is violated, another bout of selling has a probability of unfolding. Now look at the weekly chart, which shows a big red candle, and this is the second candle in a row but significantly larger than its previous one. Here again the price remains above its 25 period exponential moving average, which means the bigger picture still shows that the bulls have some amount of hope left. In the week before last, we saw the index at number 14, but last week it jumped 8 places to close at number 6. The beta or the volatility has risen, which is something I've been saying on my social media pages for many days now. If you connect with me on my social media accounts, my contact coordinates will come up at the fag end of this video. You'll see how market data that I put out towards the end of the day, including projected targets for the Nifty and the Bank Nifty, both on the bullish and the bearish side, will help you trade far better. So I've been saying in those posts that the beta or volatility is likely to jump up significantly, which is what has been happening. The budget, of course, will add significantly to this beta, which means the nightmarish reversals and large price moves can get bigger. Now, last week I advocated a range between 14,800 on the upside and 13,950 on the downside, which was violated fairly significantly, I will admit that, because the Nifty made a low of 13,596. The coming week is likely to see an estimated range. I'm emphasizing on the word estimated, between 14,100 on the upside and 13,150 on the downside. Now, I, like the Bank Nifty, would like to remind you that this is a tentative range because we don't know what's going to be in store for us in the budget, and depending on the budget proposals, you could see very large price swings in the indices as with individual stocks. So don't take these levels that I'm advocating this week, only this week, as a kind of line cast in stone. Focus on capital preservation in the coming week and trade extremely light. Now friends, I'm coming to the last two remaining segments. First is a very broad but brief what you should do in the budget, kind of a blueprint, what you can expect. And of course, the most popular segment in this video, giving you 5 stocks which are high beta, high impetus stocks wherein you take small exposure and wait for large price moves, and list of 5 stocks in which you will take large exposure, wait for very small price moves before you flip the trade over. So let's get on with the budget blueprint first. Now, since the last 2 weeks, I have been telling you that the Jensen's measure, which is a benchmark or a study letting you know whether if you're taking one additional unit of risk and not getting a minimum of 2 units of additional reward, your trade is hostile against you. And the Jensen's measure since the last 2 weeks that I told you had turned hostile against the bulls, which means buying was not really the best thing possible to do, which automatically means that it was getting to be a seller's market. The Jensen's measure still remains hostile towards the bulls, and unless it turns favorable, I would not suggest you go long in very large numbers. If you do feel like going long, please restrict your exposure levels. Now for the budget blueprint. You see, friends, there is an old saying in Wall Street which says buy on expectations, sell on news. Now in the last couple of trading weeks, typically 6 to 8 weeks, I've seen some sectors in which traders have built up anticipatory positions, and these sectors have really risen fairly high in the last couple of weeks. A few things that come to my mind are auto ancillaries, real estate, infrastructure stocks, and some select PSUs, especially those which are expected to be in the divestment list. Now, these are the stocks that are going to be highly volatile. If at all the budget announces something that is very favorable to them, these stocks might just go even higher. But like I said, buy on expectations, sell on news is the buzzword in financial markets. If at all there is a feeling of being let down, it is these sectors which you should be particularly wary about, because these will turn turtle the fastest. Now, this is a critical pre-budget update that I wanted to share with you. So stay light on these counters. Now I come to the most popular segment of this video, the 5 stocks of high beta and low beta list. The high beta stock list, where you will take small exposure, wait for large price move for a change, is led by Nifty at number 1, number 2 TVS Motor, number 3 McDowell, number 4 PEL, and number 5 Indus Bank. The low betas list, where you take high exposure and wait for small price moves, is led by Tech Mahindra number 1, number 2 UPL, number 3 Petronet LNG, number 4 Marico, and number 5 Lal Path Labs. Friends, I come to the end of this video. Coming up on your screen of my contact coordinates on social media. I do hope you can kind of connect with me. We'll get conversations going. You can check out the 3 or 4 updates that I put up, including giving you forward expected range of the Nifty and Bank Nifty for the next day on my social media account, and some more statistical studies out there. We can basically help each other becoming better traders. So do connect with me, and I'll say goodbye to you in this video. I request you to forward this video to your family and friends if you liked what you saw in the comment section. Please communicate with me and let me know what you think with this video. Click like if you really like this video. Subscribe to my YouTube channel if you haven't already done so, and click on the bell icon to receive notifications of fresh videos being put up. I wish you a very profitable week ahead. Stay safe, trade light, budget ahead, high volatility. Till we meet again in my next video. Vijay Bhambwani signing off for now. Thank you for watching. Bye-bye.